everyone. Dave Barlow here with Sell for 1% Realtors, and we're doing kind of a emergency broadcast. And you remember Rich, the old days where they'd come on the radio with the beep, beep. This is an emergency. And so yesterday we're within 20...
actual emergency. Remember that?
Oh yeah. You would have been instructed where to tune for additional information. So
Dave, we need to be quiet here.
There you go. What we want to talk about is the 0.5% rate hike that the Fed came in with yesterday. And Rich, being in the mortgage business for as long as I've been doing real estate, about almost 25 years now, has a pretty good idea of what's happened over the years, has seen the ups and seen the downs. Right now, we're in a little bit of a downhill slide, but interest rates don't seem to be being impacted the way that we would expect. And so I thought, well, let's get an expert in here like Rich to talk a little bit about what happened yesterday and where you see things going, Rich.
Well, Dave, I'll try to live up to that expert moniker that you just threw on me. And but to inform everybody, a lot of people have the notion that if the Fed raises rates 0.5 point or 0.75 of a point, that actually raises their mortgage rate 0.5 point or 0.75 of a point. And that is absolutely not the case. What the Fed is doing is they're raising the bank lending rate, bank to bank, in response to what they see happening in the economy. But that has no direct bearing, at least, on mortgages in that kind of a market per se. What the mortgage market is tuned into is a forward thinking. We're always looking at what do we think the Fed is going to do, not what are they doing right now.
Okay.
The expectation was that they would raise rates 0.5 point yesterday, and that's exactly what they did. So they did what was expected, and in reality has had almost no effect at all on interest rates. So interest rates have stayed exactly the same. Now, what can raise or lower interest rates in an environment like that, where the Fed is making an announcement, is when they do something unexpected. For instance, let's say that yesterday they would have raised rates 0.75 of a point and telegraphed the idea that they were going to raise rates in 2023 in a very aggressive fashion. If they were to have said something like that, that would have been above the expectation that the markets had, and the stock market as well as the mortgage market would have tanked on something like that, and you would have seen interest rates go up in response to the Fed raising rates yesterday. But as long as they do what's expected, typically it does not have a major impact on rates. I'll let you talk for a second, but I have more I can add to that.
Okay. So about 6-8 weeks ago, interest rates were above 7%. As of this morning, it is December 15th. And I know interest rates fluctuate even throughout the day, but what are you seeing interest rates at this morning here, Rich?
With good credit and a decent down payment, our current 30-year fixed rate with equitable mortgage, and I know that other people have higher rates, is 6%, so 6% even. Now, you're correct. About a month or so ago, rates were as high as 7.25. Some of my competition was quoting something in the high 7s about a month ago. We the highest we ever got to was around 7.25. Now, what happened that made rates go from 7.25 to 6 today is about a month ago, in November, the consumer price index number, the CPI, came out, and it was slightly less than what the markets had expected. So again, the market is baking in what they think the Fed will do next. So when the CPI number came in a little cooler than what people thought, that meant the economy was not as hot as it was previously. And so the expectation was that moving forward at some point, the Fed was going to have to stop with their aggressive rate increases. That made mortgage rates go down into the sixes from that 7.25% rate. And actually, the other day, I think it was Monday, if I'm not mistaken, CPI for the month of December came out, and it also was a little bit lower than what the markets had expected. And we saw rates go back down to that 6% level. We were at about a 6.25% to 6.375 rate beginning of the week. So you're right, interest rates are always changing. But there are things like the CPI number, the producer price index number, the jobs report, which comes out every first Friday of the month. Those are market movers because those are the things that the Fed is looking at in response to whether they're going to raise rates or lower rates in 2023 as we move forward. And
I'm sorry. So as we kind of move forward, and I think maybe, like you mentioned earlier, mortgage rates, they're loosely tied to the Fed rate because that's what everybody, is looking at, But my question has been really for the last 3, 4, 5 months as I see interest rates get up to 7%, and I see, the reports you're getting them, that applications for mortgages, applications for refis, applications for new builds are way off. And, I look at these big banks like Chase and Wells Fargo and Bank of America and the big regionals here in Columbus and Huntington, Fifth Third, PNC. And you have to think that a lot of their bottom line profits are tied to mortgages. And the more mortgages they make, the better their profits. And so the less mortgages means less profit. And how long, with demand down because interest rates are at 7%, you have to bring interest rates down in order to generate some demand. And so how long does that go on? And so we're starting to see interest rates at 6. I've seen reports that, Fannie Mae thinks that interest rates will be down in the mid to low 5s by the time we get to March, April, because again of this supply demand situation.
Right. It's going to be closely tied to what is the economy doing, because what the economy doing dictates what the Fed will do. And as we start to see layoffs, and the tech industry has had massive layoffs, and I think throughout the economy, we've seen business owners starting to cut back on hiring. Of course, when people don't have a job, they aren't going to buy as much, and the economy slows down. So right. I think that at some point, the Fed is going to have to react to all of this, and we will see a move down again from the 6% range, hopefully into the 5s. Now, one of the things I want to say to the people listening, Dave, is that this is a fantastic opportunity to buy a house right now. I remember that a year ago, it was almost impossible to buy a house unless you were the strongest of strong buyers. If you didn't have a huge down payment or maybe even cash, you couldn't buy a house. And when you did go to buy that house, maybe you got the offer accepted, it was $50,000, $75,000, $40,000 over the ask price. So you were paying way over the ask price. You were in line with 30 other people that wanted to buy that house, and you better have the strongest offer. And I can think of numerous clients who never did get a house. Right. This is their chance to buy a house right now, because they can negotiate with the seller, first of all. They can get a good price on the house, as opposed to when they were competing with 30 other people that also wanted to buy it and were making offers. Right. Maybe they even get the seller to pay a little bit of their closing costs. Yep. So if they can get at least a house at the asking price or maybe a little bit lower, and the seller pays some closing costs, let's say the seller pays $7,000 in closing costs, and they get a good price on the home. And then when rates go down, we offer free refinancing. We pay all of your lender fees. All you pay is for your title insurance. And so the saying that people have right now is marry the house, date the rate. if it's
Right.
kind of a thing. But the rate is something that we can fix later with a refinance. So if you can get a house $50,000 less than you were getting it a year ago, and you pay a slightly higher interest rate, and then we get a refinance that brings that rate back into line with what you would have gotten a year ago, you've just got a fantastic deal. So this is actually an opportunity to jump in and buy a home for people who only had maybe 5% down. Maybe they had to have contingency on selling their previous home. This is a great opportunity for those people to buy a home right now. I think they're missing it if they aren't at least entertaining the idea and talking to someone about the opportunity.
And I think that, the other thing to throw in there, Rich, and I know you guys do this, is that there are other tools that lenders have in coordination with home sellers to help get that rate down. So if you're at 6%, you guys have a program, a 2-1 buy down that the seller has to participate in, but you get a 6% rate bought down to a 4% rate. And then the second year it's to 5%. And then if rates, continue to be high, then you end up being at your 6% in 3 years. But with any luck, interest rates come back down, things level out some, and off you go. So there are other ways. And like you said, I think the big thing is that if you didn't have $40,000, $50,000, $60,000 of cash in your bank account, that you could show proof of funds to be able to outbid, the other 25 buyers, you were going to buy a home anyways.
Appraisal gap. Do you remember that?
Yeah.
Appraisal gap had to offer. Yeah.
Yeah. So, I work with a lot of sellers, and, we've talked to all of our sellers about, hey, here's an opportunity. If you're not stuck on your price on a $400,000 house, it's going to run around $8,000 to help with the 2-1 buy down. And so instead of 400, you're going to get 392, but you may have got 392 on an offer anyways. So why not use some of that cash to help a buyer purchase your property? And so again, I like that, and I think it's a good way for potential buyers to look at it as well.
Yeah, and it's a great deal for buyers as well. Let me explain a little bit about the 2-1 buy down, because it sounds scary if you never. It sounds like it's a risky loan or something. Right. It's strictly a 30-year fixed mortgage. There's nothing risky about it at all. It's 30-year fixed. And again, let's say that you were doing this today, and the normal 30-year fixed rate, as you said, is 6%. Your start rate for the first year, for the first 12 months, is a payment based on 4% instead of 6%. Right. And then this year, the payment is based on 5%. And then, as you said, if rates are still higher than that, then you would end up at a 6% rate year 3 to year 30. But the nice thing about the 2-1 buy down is the seller pays the cost of it, like you said. That money goes into an escrow account for the buyer. And it's every month when the payment's made, and we have to supplement the money from the buy down to pay for the shortfall of the payment because you're getting a lower interest rate. They take money out of that escrow account, and they make the payment complete at the 6% rate. Let's say that 6 to 8 months from now, the rates are down and you can refinance. You can refinance into a lower rate, and the money that hasn't been used on that buy down that's in that escrow account is returned to the buyer as a principal reduction on their payoff of their mortgage finance. So that money is not lost in any way. It's sitting there in an escrow account being used every month. If it doesn't all get used, the buyer still gets that money. So it's a fantastic deal to get somebody into a lower payment that maybe they just don't like that higher payment and they believe rates are going to go down. It's a great product.
All right. So, Rich, looking into your crystal ball. Yeah, I know the feeling. Where do you see, what's the word for future rate hikes by the Fed? And then what do you think interest rates will be in March, April, as we head into the spring market?
Well, the Fed yesterday made the 50 basis point increase, and they said their work is not done. So we can expect that, we're going to see additional rate increases as we go into 2023. And again, as long as the Fed does it on a very measured pace and something that in a way that is expected by the markets, it will keep rates about the same. The moment that the Fed says, hey, we're going to tap the brakes, we think the economy is slowing down, we're seeing a recession coming, we need to maybe pause on our rate increases. The moment they say that, you probably will see the stock market soar, and you probably will see interest rates go down, as you said, into the fives, maybe even lower. So the market is anticipating that day that the Fed finally says we're going to take a pause. And as long as they, in a measured way, keep raising rates for the first part of 2023, and then at some point start to pause, that's when we'll see rates really go down. If they continue to raise, and they have language that says they're going to continue to raise even more aggressively, then we may see rates go up. So there's no guarantees, certainly.
Okay. So in essence, as long as the Fed does what they say they're going to do, it's already built into the market and we should stay level. If the Fed gets nutty and does some things that are unexpected, then we can see rates go back up some.
That's correct, yes. Again, I think the thing that's expected, though, too, is that at some point in the first half of the year, they're going to say that, hey, our work is kind of done here for a while, we're going to pause. If we don't start to hear something about pausing by the first half of 2023, that could be bad news to interest rates. But I don't, you asked me my crystal ball, I think that there will be a pause at some point in the first 3, 4, 5 months of 2023.
All right. Hey, I appreciate your time here this morning. Thank you, sir.
You're welcome, Dave. Anytime, happy to help, and always good to talk to you.
All right, Rich, thanks. Rich with Equitable Mortgage. And I guess real quick, Rich, people have some additional questions, want some more information about these loan programs, so on and so forth. What's the best way to get a hold of you?
Well, I'm at Equitable Mortgage. I've been at Equitable Mortgage for, as you said, almost 25 years. So I'm not somebody that's jumped around from one company to another. Very stable. We have a stable staff who can process your loan. And you can reach me at 614-314-2666. That's my phone number, cell phone. I answer it up till 9 o'clock any day, including weekends. So call me anytime.
And I can affirm that he does answer the phone. I've talked to you many times on the weekends, so I appreciate that, Rich. Thank you.
My wife's a little jealous about that, Dave.
Yeah, I can imagine. All right, Rich, thank you. Have a great day.
Have a great day. Thank you. Bye-bye.